Dom Chu, let's turn to you, the market navigator.
All right, so let's dovetail, Tyler, off of some of the tariff and trade comments we just heard from Steve Leisman here. President-elect Trump is vowing to take that America-first approach when it comes to foreign policy. So what will that mean for those international markets? Joining me now is Gilles Moec, the chief economist and head of research for investment managers at AXA Group. Thank you very much, Gilles. If you take a look at the comments we just heard, this is very front and center for many investors right now with regard to just how the economic impacts could ripple from tariff and trade policy. Where do you see the biggest impacts?
Well, if it's just a 10% generic tariff on everything that enters the US, it's probably manageable for the rest of the world because you don't really change the relative positions of each country. You simply deteriorate their relative position compared to US producers. And in many cases, there are actually no US producers. So if it's a 10% generic hike, it's probably okay. Not great news, but probably okay. I think the 60% hike on Chinese products, that could be much more disruptive because especially in Europe, China has become a key market for our exporters, which means that if as a reaction to the tariffs, we end up with a further slowdown in Chinese demand, that is going to impact exporters the world over. The second round effect is probably also where we could get from fiercer competition from Chinese producers on third markets, on the European markets itself, or on other emerging countries. So that's probably the key to me. And there's a third element, which I think is a bit fuzzier, if you want. It's the possibility that we end up with some contagion from the US bond market to the other markets. Obviously, what is currently the platform is probably consistent with a bit more inflation, clearly, potentially a bit more growth, but that is consistent with high interest rates across the curve, I would say. And that is okay for the US, but as you know, the US bond market tends to be dominant. The other bond markets in the world tend to align themselves on the signals coming from the US. And such an increase in long-term interest rates would actually not be in the interest of many other countries, which at the moment are facing disinflationary pressure and are not facing the kind of fiscal push that we can now expect from the US.
All right. So really quickly, before we that's a lot to unwrap here and a lot to unpack. There's got to be a relative difference, right, between certain markets around the world on the emerging or otherwise that are more geared towards the U.S. or more geared towards China. Take us through maybe the thesis there.
Yeah, definitely. I mean, you've got countries in the emerging world which are very, very still dependent and reliant on U.S. demand. If U.S. demand goes up, countries like Mexico would certainly benefit. But you have other countries, for instance, in Latin America, countries like Brazil or Chile, which increasingly have put themselves in the orbit of the Chinese cycle. If China slows down, as a reaction to the policies implemented in the U.S., that could be really problematic for these countries, which have moved away from the American traction, so to speak.
All right. Gilles Moec at AXA, thank you very much, sir. Have a nice day.
It's an interesting ballet that will be conducted here if tariffs go up, because, as he pointed out, in some cases, while it might penalize foreign manufacturers who are exporting into the United States, there may not be U.S. manufacturers to take the place of them.
And of course, one of the interesting points that was brought up there for a while, and this is a long-term trend, but the other thing too is if you take a look at some of those emerging markets that are geared more towards the U.S., like Mexico, if they can relatively outperform economies like Brazil that are more dependent on China, then there might be a relative ETF play for some traders out there as well.
Very interesting. Dom Chu, thank you very much.